Good day everyone, thank you for joining me. I am Tamara Kukshinovich and I'm going to take you through Supergroup's year-end results. Pricing pressures and increased competition have affected the logistics industry globally. In South Africa, the industry is closely linked to the current state of the economy. Pressure is placed on operating margins due to the high level of competition. This emphasizes the need for strict cost controls and the upkeep of a strong balance sheet. Given the poor economic conditions, volumes are expected to remain under pressure in the short term. Earnings are supported by the recent contract wins in the consumer-facing operations, the strong South African commodities environment, and the improved operational efficiencies. Several new tenders have been submitted for state-owned companies and parastatals, which could result in further impetus to earnings of locally focused operations. Supergroup holds 59.2% in SG Fleet, which is listed on the Australian Stock Exchange. The market value of the stake is 1,108 cents per Supergroup share and is trading at a forward PE multiple of 9.5 times. In Australia, the consumer environment is expected to remain a headwind, but the balance sheet risk is estimated to be low. In Europe, the supply chain businesses are facing many uncertainties, which is impacting the outlook. We feel these concerns are fairly reflected in the current valuation. As you can see on the graph, the count is trading at a discount to its historical averages. It is also trading at the lower end of peer multiples. Trading at a forward PE multiple of 7.2 times and an implied rump PE of 6.2 times, we feel the share offers value and would recommend an overweight exposure. Revenue increased by 6.2% to 37.9 billion rand, which was mainly due to the higher volumes in the supply chain Africa commodities businesses, and operating profit grew by 7%. The operating margin improved to 7.1%. Operating profit before capital items increased by 8.1% to 2.7 billion rand, where capital items relate to the impairment of the NLC brand in Australia. Net finance costs increased by 4.9% and the average interest paid on borrowings was 6%. The average interest earned on cash was 3%. Earnings per share rose by 12.7% to 360.4 cents and headline earnings per share by 12.7% to 373.4 cents. No dividend was declared for the period in review. Operating cash flow increased by 0.4% to 3.8 billion rand. The group reported a working capital outflow of 652.1 million rand, which was mainly due to SG Fleet beginning the year with excess cash and higher volumes in logistics and the commodities businesses. 2.1 billion rand was invested in net additions and acquisitions to ensure the future growth of the group. The net asset value increased by 12.3% to 3,036.5 cents per share. Total assets increased by 6.1% to 30.3 billion rand, and the return on net operating assets remained stable at 12.3%, with the group's WACC being 9.2%. Net debt increased to 3 billion rand, which resulted in net debt to equity ratio of 24.1%, which is below the internally imposed target of 40%. In conclusion, we would recommend an overweight exposure relative to the capped SWEX, which has a weighting of 0.22% in Supergroup. If you would like to place a trade, please speak to your financial advisor or contact the dealing desk. A comprehensive company analysis report on Supergroup can be found on the PSG online trading platform. Before we end off, please take note of the following disclaimer. Thank you.